I think we'll make a start. Good afternoon, everyone, and welcome to today's webinar, which is hosted by accounting and tax expert Rebecca Benneyworth. Welcome, Rebecca. It's nice to speak to you again. At Landlord Vision, we often get questions about what expenses can be recorded and how they should be recorded and what are capital expenses. So Rebecca's here with us today to cover those areas. Before I hand over to Rebecca, I've got a couple of announcements that I'd like to make. The first one is that we are recording the webinar and it will be shared with everyone by email next week. I was going to say later this week, but actually it's a short week, so it will be next week. So please do look out for that email. The recording is a video recording, so you'll be able to see the slides on the video, but we won't be sharing the slides separately. The other is about questions. Rebecca will be answering questions at the end of the webinar. So if you have a question, please post it in the Q&A section and stick around until the end to hear the answer. But I do apologise in advance if we don't manage to get round all of them. So without further ado, I'm going to hand you over to Rebecca.
Okay, we're just doing the IT to get me made a host, and then we'll be able to start with my slides. So that's it. Fab. Right. Okay. And there we are. You can see me as well. Fantastic. Okay, so welcome to the session. And what we're looking at is some of the detailed rules that you need to be aware of when you're a landlord, when you're using the Landlord Vision software, what you can claim for, and what's the best way to go about actually keeping on top of that. Now, you might be getting things sorted out for the tax year just ended. You might be just trying to madly end up classifying everything, or you might be putting best foot forward today, first day of the new tax year. I'm definitely going to keep on top of it this year rather than leaving it all until the end of the year. So whichever it is, hopefully this little session will be useful to you. So right now then, come on computer, there we are. So what I'm going to talk about are what are the allowable expenses for residential landlords. So if you're letting residential property as a home rather than as a holiday let. And then I'll talk a little bit about how holiday lets are different, because furnished holiday lettings is that activity is treated quite differently for tax. And then I'll talk a bit about mortgages on let property. And finally, a little bit on jointly owned property, just to give you an idea about what things you need to think about and what you can and can't do when a property is owned jointly, either by a couple, so husband and wife or civil partners, or in fact, maybe by people who are not married and might be three siblings or something like that. I'll talk about how tax thinks about those. So let's start with allowable expenses. So I'm going to throw a bit of tax jargon at you to start with. Your allowable expenses must be incurred wholly and exclusively in the property business. So what that actually means is wholly and exclusively. I quite often, when I'm explaining it to people, say it's all and only. If you had an expense which was partly related to the letting business and partly not, then that's not wholly and exclusively, and you can't deduct it. Now, in fact, there are some things that are a little bit more flexible. So, for example, mileage in a car. Now, the car and the fuel and the insurance and so on, you may well use that for lots of purposes, private, going on holiday, going shopping, whatever it is, going to your job. But what we do with mileage is we allow the number of miles, and there is a fixed rate per mile that you can allow. So there is some apportionment where an individual journey is wholly and exclusively for the property business. So you're going to the property to check on the tenants and to inspect the property and maybe check out something going on in the garden or something like that. That journey is wholly and exclusively for the property business, so that's fine. Now, if in fact your property, let's say, is quite a long way away from you and you decided you'd call in there on the way to your Easter weekend trip down to the coast, then that journey would not be wholly and exclusively and therefore you would not be able to claim for it. So that's how it works, but it's much easier if we talk about specific expenses. So in no particular order, not in alphabetical or in common order, but just in no particular order, insurance of the property. You as the landlord will insure the fabric of the property. That's absolutely fine. That is wholly allowable. But what you must do is, if you do make an insurance claim, let's say there's some damage done, you need to deduct the amount of the claim from the expenditure that you're claiming it against, so that because the insurance premium has been allowed, effectively any claims will come in as if they were income. Of course, they're not rent, but if you reduce the expenses, that amounts to the same thing. If you've got an insurance policy against tenants defaulting on their rental payments, then you must treat that as rent if you make a claim on the insurance policy. Advertising for new tenants is fine. Software to keep the business records. So whatever you pay for your Landlord Vision software. And if you've got a separate bank account where only property transactions go, you could claim all of the bank charges. Most commonly, people have got their bank account mixed up, their property transactions mixed up with their private account. And in that case, no, you wouldn't be able to claim the bank charges. I personally much prefer, when I'm dealing with my clients, to have them have a separate bank account. Doesn't need to be a business account, but it just makes it so much easier because everything's separate. You're not trawling through hundreds and hundreds and hundreds of transactions trying to find the ones that relate to the property, particularly the expenses. So, as I said, travel to the property to inspect it or collect rent if you're collecting personally, and pre and post letting checks. They're absolutely fine. You can charge 45p a mile for those journeys. That's absolutely fine. The charges that your agent imposes to manage the property, so obviously when they secure a tenant for you, or any surcharges they make on any repairs that they arrange, those are all allowable expenses. If the property is empty and you end up having to pay council tax, because various councils work in slightly different ways, my local council will allow you 6 months empty, but after that you have to pay council tax and any utilities that you pay, so standing charges and so on, to keep the gas and electric turned on. If it's a short void period, then those are allowable expenses. Replacement furniture and white goods, but not the first time you purchase them. So if you've got a property that you are equipping ready to let, and you've spent a bit of money on it and you bought new fridge and cooker, then you can't claim for that. Those are disallowed. They're capital expenditure. But then from then on, when you replace them, you would be able to claim for those. And that would extend to carpets and so on. If you are buying those, then again, replacements would be allowable, but not the original purchase. And then we come to repairs, and repairs is a big topic. So I've got a couple of slides on repairs. The key thing with repairs is distinguishing between what is a repair and what is an item of capital expenditure. And generally speaking, capital expenditure is an improvement. So I get clients who say, oh, surely I can't claim for that. That was £20,000 because they had to have a new roof put on. And it isn't the amount of money that determines whether it's a repair or not. It's the nature of the expenditure. So you have to think about the property as a whole. And if you think about the property as a whole, have you replaced all or substantially all of the property? In other words, has it been demolished and rebuilt? That would be a replacement, and it would be capital expenditure. So leaving aside improvements for a moment, you can see that even if you've got to put a new roof on, that roof is part of the property as a whole. And therefore, if you've had to spend a large sum of money replacing the roof, that will be an allowable expense. You have to not be adding something that wasn't there before. So putting in an extra bathroom would not be a repair. That would be an improvement. They must be to the property or something fixed permanently to the property. So, for example, if you, let's say you had to put a couple of new kitchen units in, and these were fixed kitchen units, then that would be a repair to the property because they are fixed permanently to the property, and therefore that would be regarded as a repair to the property. Refitting a bathroom can be a repair, but you have to be careful about improvements. So here are a couple of slides with what we're thinking about. So we've taken the bath out. It's a bit scruffy and looks very sorry for itself. And we've taken it out and put it in the garden. So what are we going to put in its place? Now, although that looks a lot nicer, in terms of utility, we've got a bath. Well, all right, we've got a shower tap. But I don't think that that is an improvement. Well, of course, cosmetically, it's a huge improvement over what was there before, but you haven't actually improved the utility of the bathroom. So what would an improvement be? Well, there you go. There's your improvement. You've now got a whirlpool bath. So that would be disallowed. And what you're not allowed to do, you're not allowed to go, well, if we put in a sort of ordinary bath, that would have been 300, but this one was 600. So we'll claim the 300 replacement, but not the uplift for the whirlpool bath. You can't do that. It's a capital expense. It's an improvement. So if we replace sort of like for like or quite close, and I personally, if a client did this, I'd be happy enough with it. But if we actually make an improvement, now one of the things that you might do is you might put an overbath shower in, or you might take out a bathroom that had an overbath shower and you might put in a shower cubicle. Then the shower cubicle and the piping, so it's not just the shower, the cubicle itself and the tray and the shower mixer thingy, okay, it'll be the piping and it'll be the fitting, and the tiling around it will all be an improvement. So you can't claim for any of that. So there's a common belief that improvements have to be large amounts of money, but actually they might be made up of several small amounts of money. That pipe work to install the shower and the chap doing it, you might not think is obvious. You might say, well, we've got this from this bathroom supplier, we'll disallow the cubicle, we'll disallow the tray, but you've got to remember that the improvement is all of it. Now, what about improvements? Well, improvements will be disallowed eventually. I've got that on my next slide, but let's just talk about repairs when you've only just bought the property. So there is a real risk that if you have to undertake lots and lots of repairs when you buy the property, they might be regarded as capital expenditure improvements and therefore disallowed. And the question you need to think about is, was the property capable of being let when you bought it? So let's say you bought it at auction, been unoccupied for 15 years, it's been knocked about, it's had squatters in it, it's in a terrible state, and you've got it for a knockdown price of whatever it was, okay? Then obviously, although in nature they're repairs, what you have to recognise is that the cost of the property, if it had been habitable, would have been much higher. And therefore, you've got to deal with the fact that the repairs are effectively added to the cost of the property. Now, you might want to seek advice on that. It can be quite complicated, but I tend to say to clients, let's have a look. What have you done? I've got a client landlord who, if he buys somewhere and it's got a pink or a blue or an avocado bathroom suite in, he rips it all out and puts in white. Now, the reality is he could have let it with a pink or blue or an avocado bathroom suite in. It was perfectly serviceable, but he prefers to have a nice clean white suite in it. I tend to be relaxed about that, but if he said to me, well, I'm going to put a shower in as well, then I would be saying, right, there's some improvements there. And this particular client has a large property portfolio. And what we tend to do is we have a quarterly meeting and I say, right, you've bought these ones. What have you done? What are you doing on those properties? Are you having to gut it? Is it a 3-skip job? Because he's had those. Or are you just tidying it up a bit? And that will determine what view I take about whether it's tax allowable or not. So bringing all that together, if you're carrying out improvements, they are capital expenditure. You can't deduct it against the profit and get tax relief on it. However, most of that money is likely to be allowable when the property is sold. Now, I say most of because the test for capital gains tax is expenditure on improvements which are reflected in the value of the property when it's sold. So I had quite a discussion with one client once. They'd owned the property for about 40 years. They put central heating in the early 70s. It pretty much hadn't been touched since. And what they wanted to know was why I was not taking the cost of the central heating and allowing that in the capital gains tax computation. And what I said is, look, you know, you put that in back in the 70s, that needs doing again now. So really, I can't argue that that actually adds to the value when you sell it. And that's the allowance in capital gains tax, but that's quite rare. If you put a conservatory on, if you've rehashed the internal layout, put extra bathrooms in, put in shower cubicles in bathrooms where there was space, just keep a record of that within your Landlord Vision software. You can add that to the capital cost of the property, and then when you come to sell it, you'll have the dates of the expenditure and what you did all recorded for you. It's actually quite a good idea to take before and after photos, because if then you get a challenge when you do the capital gains tax and HMRC comes back and says, what is this and why was it? You've got some records. And nowadays with digital photographs, you can just pop those in a folder. That's a good idea to actually add to your argument if you were to get into an argument about capital gains tax. Okay, so that's residential letting broadly. Now let's have a look at holiday lets. And holiday lets are treated very similar to commercial property. So let's have a look, because you might be letting shops with flats above. So your shops are slightly different. So there are 3 major differences with holiday lets and commercial letting. First of all, capital allowances will be available on what's known as plant and machinery. Now, that's quite a surprisingly wide category of expenditure and includes things that you would not think of plant and machinery, and I'll get to that in a minute. We're going to do that in a bit of detail. Secondly, and we're covering this a little bit later, there is no restriction on the interest on borrowing. So if you've borrowed and you bought a row of shops with no flats above, just a row of shops, you will be able to deduct all of the interest on the borrowings that you raise to do that. Whereas in residential letting, I'm sure lots of you know that's not possible. And thirdly, you've got to think about VAT. Now here, holiday lets and commercial property vary slightly. So with holiday lets, the letting of furnished holiday accommodation is standard rated for VAT. What that means is that if you have got several and you end up turning over more than £85,000, you must register for VAT and you must charge VAT on your rentals. And a lot of landlords don't want to do that because it obviously puts the price up, it makes them less competitive. And if they reduce their price to be competitive, a sixth of that is going off to the VAT man. But there can be benefits, because if you've got to spend a lot of money on it, you're then going to be able to get your VAT back. Now, with commercial property, it's a bit more complicated. You can choose whether or not you want to charge VAT on the rent. That's called option to tax. And we're not going any further with that because that all gets a little bit hairy. Okay, so 3 major differences between commercial and holiday letting and residential letting. So let's just talk about this plant and machinery, because I'm conscious that some of you listening may well have holiday lets and they have a very advantageous arrangement for tax. So plant and machinery will include all your furniture, your sofas. So we're not worrying about replacement. First purchase, capital allowances. The replacement rule doesn't apply because you're going to get capital allowances on it all the way through. Televisions, music systems, whatever wonderful things you put in, you will be able to claim for. So even a hot tub. So I know somebody who's got a furnished holiday let, and they put a hot tub and they put a sort of garden sort of awning in. Yep, allowance for that. And the allowance is currently 100% in the year you spend the money, up to a maximum of £1 million a year. You don't have to claim it all, because obviously you might actually spend a lot of money doing somewhere up a bit. So you've got it and you've decided we're going a bit up market. We're going to have all new beds, all tellies in every room and all the rest of it. And then you will have a big claim, and you probably don't want to turn it into a loss. You can't, furnished holiday lets, you can't set the loss off against anything else. You only carry it forward. So you might just want to claim just enough. And if there's anything left, you can claim that at 18% a year. If you're actually doing building work and completely refitting a property, what you will find is that there is even more. And this is what I meant by a surprisingly wide range of expenditure, because pipe work, wiring, all of your bathroom fittings, so your loo, your sink, your bath, your shower, in your kitchen, all your kitchen units, all of the white goods would all attract capital allowances. But I put at the bottom there, seek advice, because it is quite a complicated area. But there's a whole load of legislation that says, oh yes, you can claim this, you can claim that. Boilers, brand new boiler, or heat source, heat pump, all of that sort of thing would be available for a capital allowance claim. Okay, so let's move on to another very, very common expense, and that is interest on a mortgage or other borrowings, actually, which is related to your letting activity. Now, here I'm going to talk about residential property letting mainly. So provided you borrowed the money and you used it in the property business, then you may well be getting tax relief on the interest, but never ever the capital repayments, whether we're talking about commercial lettings, furnished holiday let, or residential lettings, never the capital amounts, just the interest. So if you've got a repayment mortgage, you're going to have to split the payments, and you will get your interest statement probably after the end of the year, where you can actually split out payments between capital and interest. It applies on loans not just to buy the property, but you might have had to borrow some money to finance some major repairs. You might be buying a second property and be raising the borrowing secured on the first property. That's fine. I don't mind where they're secured. It's where you use that money. Where does that money go? If it goes into the rental business, you're going to be able to make an interest claim for it. Now, on residential letting, you can't deduct it from profit. You will actually make a deduction against the tax due. And I've got a little bit of an example here. So I've said, let's imagine that the net profit from letting is £12,000. So that's your rent less all of your expenses for the year. The owner is a higher rate taxpayer, so the tax would be 40% of that, £4,800. They paid interest on their borrowings of £5,000. So in economic terms, their profit is 7,000, not 12,000. Okay, but they can't have that for tax. They've got to have 12,000 as a taxable profit, and then they can deduct £1,000 from their tax bill. So the tax bill goes down to 3,800. Now, in fact, what that then does is for higher rate taxpayers, it reduces your post-tax yield. So our real economic yield is 12,000 minus 5,000, which is £7,000. That's what we're actually making. Okay, now our tax is 4,800 minus 1,000 is 3,800. So your post-tax return is actually only 3,200. So that's eroded your post-tax return. And in fact, your effective rate of tax, 3,800 over 7,000, can't work it out exactly, but it's more than 50%. So when Mr. Osborne announced that change back in 2015, that was really quite a shock. It took some time for it to come in. It took until 21 for it to be fully in, which means that it was phased in over a period of years. The actual pain of this was really only started to be felt about 18 months ago when people got their final tax bills for 2021. So whether that is partly to blame for a lot of landlords selling up, I don't know, but bear in mind that if you are not on a fixed rate, if that is going up, and let's say rates have increased pretty significantly, so let's increase that to 7,000 in the current year, then your economic yield is going to be 5,000. Okay, your allowable interest is going to be 1,400. So we've got, or your tax allowance, we've got 3,400. Now my post-tax yield is only 1,600. And my effective rate of tax at 3,400 over 5,000 is 68%. So as that mortgage interest goes up, that hits your yields really hard. So that's the situation with residential finance costs. You work out your profit and then you allow 20%. Now, if, let's say you had a bad year, you had some void periods, and let's say your net profit from letting was only 2,000 because somebody trashed the place as well as not paying their rent, then your tax is going to be £800. Oh, sorry, 800. Hang on, let me get my eraser on here. Your tax is going to be £800. Then you can't actually relieve all of your interest, but it is carried forward to future years. But by having it as a deduction, you can't have a negative amount of tax. So if you have a really bad year, then you may find you're carrying your interest forward to the next year. Okay, quite a lot of sums there. And finally, my final little topic is jointly owned property. So we've got different rules. If you are a married couple or civil partners, then tax law says, I'm not going to interfere into your marriage arrangement, so I'm just going to say it's 50-50. And there is no obligation on anyone to disabuse HMRC of that. In other words, if it's jointly owned, doesn't matter if it's 90-10 or 98-2 or whatever, doesn't matter, you can just sit at 50-50. Now, if you don't want the income tax 50-50, you have to have it that it's not owned 50-50 and that you share the income in the proportion owned, so 90% to one, 10% to the other, then you can make an election. That's called Form 17. Again, you might want to take advice about that. Okay, so it's an assumption of 50-50. I don't care, but it must be jointly owned. It's no good saying it's 50-50 if one owns all of it. Okay, it must be jointly owned. If it's jointly owned, it's 50-50. And if you don't want 50-50, it must be owned in a different proportion. And then you can split it in that different proportion. That's quite common where one of the couple is a higher rate taxpayer and the other is a basic rate taxpayer. Okay, then you'd have to have the property owned in a different proportion and also pay the net rents out in a different proportion. It's no good putting them in a joint bank account. And then you could make the election. For everyone else, brothers and sisters, mothers and sons, you can split it however you like. So if there's net rents of 12,000 a year, and you decide that mum's going to take 5,000 and son's going to take 7,000, that's what goes on the tax return. Now, you do have to be prepared to demonstrate that that's how much money each person got. Yeah. So where it's jointly let and they're not a married couple or a civil partnership, you can do whatever you want. If one of them, I've got a friend, she said there's 3 of them own the property. And one of them collects the rent, does all the inspections, does a bit of handiwork, mows the lawns. So they take the majority of the rent and then the other 2 have a little bit each. So that's what would go on the tax return. Okay, so I'm going to stop sharing now and I'm going to hand back so that we can do a demo now. I think I need to make. I
can reclaim the host here.
Oh, can you?
What we should do? Yeah, I'll do that now.
Yeah, okay. And then folks, stick around because I'll answer the questions after we've done the demo. Okay, so I've now got control back. So I'm going to very quickly share my screen and touch on some of the points that Rebecca has mentioned and how they're dealt with in Landlord Vision. So I hope everyone can see my screen. Just the last point that Rebecca made about jointly owned properties. Now, in Landlord Vision, that's set up from the very beginning. So as you create your portfolios for your properties, you can put in any number of owners against that portfolio and including the ownership breakdown percentage. So you'd be able to edit this according to your own setup. Now that sits at portfolio level, but once you've created the portfolio and you start populating that with your properties, you can even drill down to ownership at property level. So if you have a property where the ownership value is split slightly, you can change that against the property itself. So if I just scroll down here, I can have same as portfolio ownership, or I can then say, okay, only 2 of us own this and it's 50-50 and save those changes. And what then happens is when we're pulling reports about the income and expenditure, Landlord Vision knows how much to pull from each expense into those reports. So that's a great way of managing your jointly owned property in Landlord Vision. Now, once you've set up some properties, it might be that you actually have a property that's an HMO or it's split into several different units, and you can do that in Landlord Vision as well.
So not only do you set up the property, you then set up the units between. And again, you can allocate income and expenditure right down to that unit level. So at all times, you've got visibility of what each of those units is earning you. Now, in Landlord Vision, there are 3 ways of entering expenses, like the ones that Rebecca talked about, you know, repairs, capital expenses. The first is to add them in manually by just clicking on Add Expense. Now, if I just draw your attention to cost type over here. So we've got item cost, service cost, and then these last 3 will all refer to capital costs. So capital costs, buying and selling costs. You would just choose which one is relevant to the expense that you're recording. And then that will then get pulled through to a capital gains tax report that we'll look at just very briefly in a moment. Now, with the expenses, you can put in any of your expenses. So I think we talked about furnishings, didn't we? Oh, no, I haven't got one set up, but I was going to show you that, but I'll pull in a capital cost. Now, with the capital cost, you can even, if I just move that out of the way, it could be for the whole portfolio, or it could be for individual properties. Whatever this expense is for, you can break it down as you need to. You don't have to set up different expenses to show what an expense is for. You can break it down into several different properties, or for the portfolio as a whole. And one thing I will say about expenses in Landlord Vision as well is it automatically apportions them to the tax year as well. So where you have a service cost that perhaps spans a tax year, Landlord Vision will put the correct apportionment into one tax year or the other. Okay, so now the second way of being able to enter expenses is via scanned receipts. Now, Rebecca talked about, holding photographs and images of, having evidence of the expenditure that you're incurring. And using the scanned receipts option is a great way of doing that. Now, I live at Wicks. This is screwed up. It's been in my back pocket, but still Landlord Vision has been able to pull out that information. And from here, I'm able to create the expense very quickly. You can see it's populated quite a lot of that invoice already. All I have to choose which account it's going to sit against, and whether it's portfolio cost or if it goes against individual properties or just one property, and also how it's been paid as well. So that's nice and quick, speeds things up incredibly, doing things that way. Now, the third way of recording expenditure in Landlord Vision is using the bank reconciliation area. Now, in Landlord Vision, you can import bank statements manually, or you can get live bank feeds. So this connects to all the most popular banks. It's very simple and easy to set up. Simply click on your bank, click on agree and log in, and then you authorize the connection. And that's a great way of getting your expenses into Landlord Vision very quickly. And then they'll be displayed on this reconciliation screen for you. So where Landlord Vision will find a match, so these are the transactions imported, these are the transactions that Landlord Vision are expecting, where it will find a match, you simply click on OK. Now, if you know that expense is in Landlord Vision already, it might be that you've had an invoice, but you had 30 days in which to pay it, so you know you've not paid it off. You can then quickly click on Find a Match manually and match it up with the expense that is expected in Landlord Vision. If you know this expense is not in Landlord Vision anywhere, you don't have to go back to Property Manager to enter it in. You simply click on Add Expense at this point, and you're able to then enter this expense from here. Now, we have a real mixture of portfolio sizes. So from our, we have some customers with 1 or 2 tenancies, and this is great. They can import this statement at the end of the month, go through allocating income, allocating expenses. That's fine, but equally the live bank feeds come into their own, where we have the larger tenancies where they're needing that live bank feed, and they're managing and reconciling their transactions on a daily basis. Okay, now another thing that Rebecca mentioned was mortgages. So the finance manager, this is a great way of keeping track of your mortgages. Put in the start date, the end date, the loan amount, and the computation and what your interest rate is, so that Landlord Vision can create this payment schedule for you. Now, when you're adding a payment in, as Rebecca said, you've got to keep a track of, if it's a repayment, how much is capital, how much is interest, or if it's an interest-only mortgage, how much are you paying? And you can do that here in Landlord Vision as well. Okay, now all of this information that we're putting into Landlord Vision, all of that is getting pulled through to these reports here. So with the finance reports, that if you're going for a remortgage and you need to show your mortgage advisor what loans you've got outstanding, how long you've got left on them, etc. These two reports are brilliant. You'll be able to pull this off and just present them to your mortgage advisor. Now the capital gains tax report here. So what this does is pull in those expenses that we created up in Property Manager. Anything that had that capital flag allocated to it will get pulled through to this report. And here we can choose the property we want to run it for, what the ownership is. So if it's not solely owned, you just put in the percentage for the owner and then apply. You can use the selling date, or you can use the latest valuation data. You're able to choose. If it's hypothetical, you're thinking, oh, what would my liability be if I sell this property? You could use your latest valuation data, and then simply click on apply, and it would pull in all of those expenses: valuation, survey, conveyancing fees, capital costs, extension, designer kitchen. That would be lovely, wouldn't it? Nice designer kitchen, and solicitors' fees. And then at the bottom, it would give you what your liability would be. So that's a really good report if you're thinking of selling or if you are selling. The income tax report. So this also pulls through the expenses that you entered into Landlord Vision up here in Property Manager. So these are the ones that go onto the income tax report. You can choose which owner you want to run the income tax report for, and whether you're using cash basis or accruals basis accounting, and then simply click on apply, and it will give you the figures for your income tax return. And you can see that we've numbered them. 20 is an odd number to start out, but you'll find it correlates directly with the self-assessment tax return. I'm just going to quickly scroll down to the bottom here. The tax reduction, which Rebecca also talked about, Landlord Vision also does that as well. So that's sort of the expenses area in Landlord Vision. I don't want to take up too much of your time because this was really just about expenses. Landlord Vision's got a lot more to it, and hopefully I'll get to go through that with some of you going forward. I'd like to now maybe come back to the questions. So I'm just going to stop sharing and we'll read a few of the questions that have come in. Okay, Rebecca, can you hear me okay?
Yes, I can.
Perfect. Okay, so the first question, can I claim for hotel accommodation for the night of a property far away?
Yes, so if you've got to travel to visit the property, to inspect it or whatever, yeah, that would be fine. That's an expense which is wholly and exclusively related to the property which is let, not a problem at all.
Perfect. Okay, another one said, is upgrading fire separation to meet new regulations a repair?
I think it's an improvement. I've been asked that one before, but if you think about it, does the property meet the fire standard now? No. Will it meet it afterwards? Yes. Now, sometimes, let me just drill into this a little bit more, and I don't think they have, but sometimes what HMRC says is that, for example, double glazing. If you replace single glazed windows with double glazing, that is an improvement. However, because double glazing now is sort of like the minimum standard, they accept replacement double glazed units. So if you rip out all your old wooden windows and you put replacement windows right through the property, that would be allowed. Now, they specifically say replacing single glazing with double glazing. Whether HMRC will have a think about it, I mean, I would imagine the National Residential Landlords Association will talk to HMRC about this, but whether they will say fire regulations and maybe the EPC stuff that will be coming in over the next few years, whether they will say that would be acceptable. So at the moment, it's an improvement. But it might be that in the future, HMRC soften that line a bit and allow it.
Okay, so the next one, it says, hi, Rebecca. Is this webinar more focused on bookkeeping for individual landlords rather than landlords using a limited company?
Right, so the only thing that's different with a limited company is the interest restriction doesn't apply. So you can deduct your interest in full in a limited company, and it comes off profit. So that, remember that 12,000, and then I have £5,000 worth of interest in a limited company, that will be deducted in full. But that's the only bit that's different. Everything else is the same.
Okay. Next question. I assume the new EPC upgrades are improvements.
Yeah, I think they are. I do think they are. So because what you're doing is you're improving the energy performance of the property. Not that you as a landlord is much going to benefit from it, except of course there will come a time when you can't let the property. But yeah, I think that's an improvement. Yeah.
Okay. Next question. I've got a buy-to-let terraced house with a chimney shared with the owner-occupier next door. There is water leaking in both sides. Local roofers recommend taking it down below the roof line and building up a new part of the roof to seal it back up again. I'd have thought this is maintenance and therefore tax deductible via my limited company. If I share the cost with the neighbour, do I pay for the whole job or my equal share, i.e. half?
Okay, so yes, absolutely, that's a repair. That's a good example of a fairly chunky amount of money that would be allowed. If the neighbour is going to pay for half of it, then all you'll be able to claim is your half. So you pay half and they pay half, or you pay all of it and they reimburse you. But there's always a risk they won't. So I think you need to get it set up so the builder's quite clear that he's coming to you for half the money and the neighbour for half, but you would only be allowed to claim for the bit you paid for.
Okay. If you have a disabled tenant and have been requested to provide a support aid, such as an extra banister, would the cost be allowable as a repair for tax for residential lettings? I understand this may be covered under the Disabilities Act.
Oh, what a very good question. See, I think it's an improvement. What I tend to say, this is where accountants go all technical on you. What I tend to say is if it's not that much money, I would say it wasn't material. In other words, it's not big enough to get overwrought about. But if it was a couple of £1,000, I think I'd probably have to say it was an improvement, because you're adding something that isn't there. If you were needing to make the rail that's there a bit more robust, I'd say it was a repair. So yeah, on balance, I think it's probably capital.
Okay. Have we reached the point where taking rental property into a limited company is now more viable, even for just one property?
Well, the trouble is it's getting it in there, because if you already own it, then you're going to have to pay another slug of stamp duty, land tax, to get it in the company. So, but certainly it is worth looking at the limited company when you buy the property, because if you're buying a buy to let, then your extra 3% is on it anyway. So it's on it if it's a company, it's on it if you buy it personally, because you've already got a home. So that's neutral. Now, it'll cost you a little bit more money to have company accounts done. I charge quite a bit more for a set of company accounts and corporation tax return than I do for an income tax return, simply because there's a lot more faffing about and a lot more formality to it. You would have to have a limited company separate bank account. You absolutely must have a bank account in the name of the limited company. But that extra tax relief on the mortgage interest might well be worth looking at. So your problem is, if you already own it, let's say you've got one, okay, if you already own it, you're going to pay stamp duty, land tax to get it into the company. And you're then also going to pay capital gains tax, because you will have to transfer it to the company at market value. So if it's gone up in value, you've got a whole load of tax. And at that point, it's not worth it. It's just not worth it. But if you're starting out now, or maybe you've got a small portfolio and you want to get half a dozen more, then it's definitely worth looking at a limited company for that. So, and even for one, it depends where you are with your mortgage, but I tend to take the view that it's definitely worth looking at. Excuse me.
Bless you. Thank you. Okay, so this question is, will a copy of the slides be provided post-event? I'll answer that one if that's okay. Yep. We won't be making the slides available because we're videoing the webinar, so we'll be making that video available to everyone next week. But contact me if there's any problems. Okay, so the next question, what happens to mortgage interest if you have a limited company?
Right, I have covered that, but I will just address the question. Your mortgage interest is fully allowable in the limited company, and you don't get that 20% restriction. So that's worth thinking about. Just going back to limited companies for a second, of course, the corporation tax rate is going up, and it's going up with effect from the 1st of April 2023. Now, if your total profits in your limited company are less than 50,000, you will still only pay 19% corporation tax. But if your profits go over that, you'll be paying more in corporation tax. And that means that when you want to take the money out, your effective rate of tax could be in the low 50s. So you need to think, you need to set it all out. If you're looking at, should I go limited company, you need to set it all out and work through it. I had a client, we sat down, they've already got one and they were looking to buy another two, and we sat down and did all the figures. And once he talked to the mortgage broker as well, he decided on balance he would stick where he was. Now, that was 2 years ago. I should think if he wasn't on a fix, he's probably regretting it now because his mortgage his interest has gone up. But, you really do need to do a bit of number crunching.
Okay. Excuse me. In joint, sorry, passed your tickle over to me. In joint owned properties, brother and sister, one party does all the work and wants to run it as part of their business, incorporated. Do they need to sign a lease or license between both parties and the corporate, or is that not necessary?
Yes, I think it is. So if the one who's doing all the work wants to report that through their limited company, at the moment, the limited company does not have an interest in the property, so it can't receive rent because it doesn't have a right to receive that rent. So to create that right, you'd have to give a license to occupy, and then the company would have an interest in it, and then the company would be able to charge rent. So yes, and you probably need to get a lawyer to get involved with that so that you get it right. One thing on that, you've got to be really, really careful is where your borrowings are, because if the borrowings, let's say A and B are individuals and they own the property jointly, and each of A and B have got borrowings, if you grant a license to the limited company, the limited company hasn't got any borrowings, so you'd have to put enough rent into A's hands in order for A to cover his mortgage interest. So it's a bit messy. So you might need to take advice or just sit down and crunch the numbers a bit before you do that. But yes, in principle, you do need a license.
Okay, I think we'll manage to squeeze in a couple more. Do you get tax relief on repairs to a let property after the tenants move out and you move in?
See, the argument might be that it is not incurred in relation to the letting activity. I think probably not, actually. I think not. If you were going to re-let it, of course, because you're just putting it back in order for the new tenants, and most of you have to do a decoration or something, remedial work between tenants. But if you're moving in yourself, no, because that's for you, isn't it? So no, not allowable.
Okay. Is Airbnb a holiday let business?
Well, it might be, but in order to benefit from the furnished holiday letting rules, the property has to be available for letting for 210 days a year and actually let for 105. So if you're Airbnb-ing, it's probably going to have to be only Airbnb. If you've got a nice house and you move out for 4 weeks a year and you Airbnb it, then I live near Cheltenham. A few people do that around here. When Cheltenham races are on, they just bung it on Airbnb and make a nice fat packet. In that case, no, it's not going to be a finished holiday let, because to get 210 days out of 365 available, and HMRC might ask you to show when it was being advertised on various sites, and 105 days let, it's got to be virtually full time. So hopefully that makes it clear. But yes, Airbnb might be the way that you let a furnished holiday let, or you might have it on, you know, Sykes cottages or whatever. But you've got to meet those letting rules. Now, once you've started, if you can meet those rules once, then if you have a bad summer or COVID strikes, you can elect to have met them a second year. But you've got to crack your first year. You've got to crack that 105 days in the first tax year. Otherwise, you're not going to be able to get benefits of what is essentially very favourable tax treatment.
Okay. Well, I think we've just got time for one last question. Is getting a property up to the required EPC level, which will be mandated, a capital item?
I think it is at the moment, and I think it's possible that representatives of the landlord sector will be asking HMRC for some, maybe a bit of leeway on this. But at the moment, if you've got to put double glazing in, double glazing is fine. See, what would you have to do? That's the thing. If you've got to put see, I start off saying it's an improvement. Well, double glazing would be fine, but what else might you have to do? You might have to add loads of extra insulation.
Yeah, loft insulation.
Be an improvement if you've got to up your insulation in the loft, or if you've got to have injected cavity wall insulation. Those would be improvements. So you need to look at what you're doing, but in principle, I think a lot of it is going to be improvements.
Lovely. Thank you very much. So we've just hit the hour now. So Rebecca, thank you so much again for joining us. And I'd like to thank everyone else for joining us today. Hopefully this has gone some way to help you set up your expenses and understand what you can claim for and how things are categorized, and have the best tax year yet. If anyone wants to learn more about Landlord Vision, please jump onto one of our demos, which we hold daily. If there isn't a slot available at a convenient time for you, then please do just get in touch with me and we'll arrange one with you directly. So Rebecca, if there's nothing else that you'd like to add, or?
No, I don't think so. I mean, we've had questions steadily coming in. We haven't quite managed to answer them all, but if we do another session another time, we'll pick up some more questions then.
Lovely, that's brilliant. So thank you again, Rebecca, and thank you everyone for joining us. Have a lovely Easter weekend.
Have a good Easter, everyone. Bye.
Bye.